think dividend stocks have been seeing a large amount of challenges because of a rate hike cycle over the last couple of years. We have finally seen the reversal that we anticipate with the July potential rate cuts and further rate cuts going forward. It is likely to be a more favorable environment for dividend stocks. Companies are paying more dividends, investors are paying more attention to this, and in an era where growth is slowing down, I think strong cash flows and high dividends will be an area where investors will focus on more so going forward.
In this environment, we think that income investors should focus on two themes. And one is that to find income sources that are relatively insulated from global trade tensions. And we feel that U.S. mortgage credit is relatively insulated from global trade tensions, being more focused on the housing market, which is still pretty solid in America. The second theme is that because the current trade tensions is darkening the economic outlook, central banks, led by the Federal Reserve, will likely begin to ease monetary policy. And so you want to invest in those markets that will benefit from that. And we think that select local currency emerging market bonds may be that market, because a handful of EM countries, they have tightened up monetary policy in the last 2 years in response to Fed hiking rates in the last few years and the strong dollar. But now that the reverse is happening, some countries now have room to cut interest rates. An example of that is Indonesia.
I do believe that while investors should be taking rational decisions, and I'm generalizing, people do tend to get influenced by some behavioral biases. So in the course of my presentation, I spoke about some of those behavioral biases, whether it's anchoring, herding, which essentially means following other people's behaviors, overconfidence, which is relying too much on data and information to make decisions, and finally loss aversion, which also leads to risk aversion in client portfolios as well. And the whole logic was to make them aware and also speak about some of the tools they can use to avoid some of those behavioral biases as well.
Generally, you would expect the emerging market economies and currencies to do well. That's broadly the case. But vis-a-vis the ringgit, we still expect the ringgit to be range-bound. In fact, by the end of the year, probably about the 4.15 sort of range. So not too much different from where it is. Part of the reason why the weaker dollar, we don't think it's going to lead to a significant ringgit strength, is part of the reason is because the overhanging concern of the possibility of Malaysia being removed from the Citigroup World Government Bond Index. That benchmark is really critical. The inclusion or the removal of Malaysia from that can have implications of the money flows, particularly into ringgit bonds.